Climate tech investment dips as AI surges, threatening climate action. The global investment landscape is witnessing a shifting terrain as generalist investors increasingly divert their attention and capital toward the burgeoning artificial intelligence (AI) sector, leaving climate tech startups grappling with the challenge of reduced funding. This pivot is raising alarm bells for an industry that is at the forefront of combating climate change, a mission that is both urgent and critical. Data from Bloomberg NEF highlights the stark contrast in investment flows. While climate tech companies managed to secure approximately $10.3 billion in equity across public and private markets in the third quarter, projections suggest that their funding could plummet by nearly 50% this year. In the same breath, AI startups have experienced a surge, amassing over $21 billion in the same period, according to PitchBook estimates. The sheer enthusiasm for AI has seemingly overshadowed the importance of climate tech, with Matt Eggers of Prelude Ventures likening the situation to the mobile tech frenzy of 2010. It's not just the AI hype that's solely to blame for the dwindling financial support for climate tech initiatives. A confluence of factors such as spiraling interest rates, rampant inflation, and geopolitical instability began affecting funding even before AI dominated headlines. Nonetheless, this trend could not have come at a worse time. The climate tech industry, still in its nascent phase, embodies a diverse array of innovations, from energy storage and carbon sequestration to sustainable agriculture and renewable resources. Consequently, these startups often require substantial investment as they enter and navigate through capital-intensive phases of development. Pioneer technologies such as nuclear fusion and green hydrogen production are resource-heavy, and their market deployment remains on the horizon. Meanwhile, AI investments seem to promise a quicker return, with some entities already boasting billions in revenue. This divergence in investment patterns raises concerns about the global community's ability to mitigate the impacts of climate change. Environmental advocates like Bill McKibben stress the imperative need to act swiftly, warning that time is running out to make meaningful interventions, especially in the shadow of significant political events like the U.S. presidential election. Despite this significant challenge, not all climate tech enterprises are facing financial droughts. Standouts like Form Energy Inc., an iron air battery startup, garnered a substantial $405 million in Series F funding, evidencing investor confidence in endeavors that show strong demand and clear paths to profitability. Additionally, targeted funds remain dedicated to the climate cause, reinforcing the notion that shrinking climate tech investments are notably from generalist tourist investors. There is, however, an interesting intersection of interest where climate-related AI and software companies are increasingly gaining traction. Their lower capital requirements and scalability are attracting investors, and this could potentially kindle a synergy between the two fields, meshing technological innovation with environmental sustainability. Thank you for choosing Satori News.